Well, good afternoon and welcome to our weekly High Rock video. We do this in order to talk to our clients about what we see happening in the global economy and financial markets and the world of wealth management. We try to do it on a weekly basis. If you are a first-time viewer and you want to find out a little bit more about High Rock Capital, please visit our website at www.highrockcapital.ca. All right. As our clients know, we have three models that we use to give our clients allocation, usually across all three of the models. That is because we want to try and give them some diversification across all the different asset classes.
And geographies.
And we want to do that for the very reason that we think managing risk is the most important aspect of what we do, and trying to mitigate risk by having that diversification we think is paramount to what we're trying to accomplish. So we have the three models. The fixed income model, that gives us annual cash flow and stability. We have the global equity model, which gives us that broad equity diversification. And then for special opportunities that we see from time to time, we have a tactical model, which gives us exposure to mid and small cap Canadian, both fixed income and equity. But from time to time, we will move off to other opportunities, and Paul's going to talk about one of those right now.
We are. General Electric. So General Electric is a Dow Industrial Average 30 stock. It's one of the 30 stocks in the Dow. And it is the only Dow stock down on the year to date, and even after this morning, down even more. And the opportunity in GE is the following. I think, as you can see by the yellow line, that's the Dow Industrial Average is moved significantly higher and to new highs pretty much every day. And the white line is the stock of GE. GE has a new chairman and CEO, and he's holding an investor day on Monday, November 13th. He is cutting the dividend by 50%, and I think that was called for. GE right now has negative free cash flow of about $5.5 billion a year. So taking about $4.5 billion back through a dividend cut is a good thing. Bad for those stockholders who were buyers up at higher levels and hoping for the dividend to remain, but just not to be. Anyway, there are a lot of changes going on with GE, and we've decided to take a position in it in our tactical model, and we're layering into it in a measured way. The stock is getting hit on the back of the investor day, and we just bought a little bit more this morning on it. So this is one of our opportunities. The second opportunity is one we spoke of a couple weeks ago, perhaps, and I spoke about on BNN. Oil is moving higher, and I think people are following news in Saudi Arabia over the past week and a half. There's something going on in Saudi Arabia, and I'm not an expert in the Middle East, but my view is that I think we're on the precipice of war, and I think it's going to be between Saudi Arabia and Iran. I think the price of oil could shoot up a lot higher here, and that could actually has ramifications for the U.S. economy. Nonetheless, to what we're doing here, oil is the yellow line, and oil has been moving higher, and the white line is Baytex stock. And as you can see, over the past week alone, it's moved higher. But up until then, the last year to date, the gap was moving wider between oil, the yellow line, and the white line, Baytex stock. The green line is a Baytex bond, which has been very steady, up just around $97, $98. So we did initiate a position 2 weeks ago in Baytex stock. We bought some at 323. We sold out a half of it at 416 last week. I'd like to have a bigger position in this stock and a couple others, but they moved so much higher so quickly last week that we didn't get quite the position on we had hoped and wanted. And we'll try and wait for a bit more of a pullback and be disciplined on it for now. So the other thing that's happening out here is, and something we haven't looked at in a while, is looking at the U.S. yield curve and looking at it as an indicator of a U.S. recession. So, Scott, something we used to track weekly, but is the U.S. 2-year to 30-year, which is the entire yield curve, versus when U.S. recessions happen. So, what's it telling us now?
Well, the interest rate spread that we look at between the 2-year and the 30-year has continued to narrow. And we've pointed this out on many occasions, and we used to do so in our webinars when we were doing those. But what we've seen is that continuing of that narrowing. And you can look back historically and see how when that gold line approaches zero, and in some cases it actually gets there, but the real key is that what follows behind that often and historically has been a recession. Certainly in the last 3 recessions, a flattening or even inverting yield curve have been followed by a recession. So obviously we want to be very careful about what that is telling us. We see this yield curve continuing to flatten. We think that heightens the probability of a recession in the not too distant future, and we want to be aware of that, especially when we're making our doing our fixed income strategies.
What do you think is driving the flattening?
Well, there's a couple of things that are driving the flattening. One of them is the fact that the Federal Reserve has been raising short-term interest rates, so that pushes short-term interest rates higher. At the same time, longer-term bond investors who buy bonds are not experiencing inflation, so they're not demanding that premium for inflation. And in Europe and in Japan, the central banks have been continuing to buy longer dated bonds as part of their quantitative easing process, which goes back to the financial crisis and when they were adding liquidity. So with all of this bond buying going on in Europe and Japan, it's forcing other bond buyers to move into the U.S. market and buy their bonds there. So lots of things happening to drive that.
Yeah, it's interesting.
And of course, one of the things that we're always looking at as far as our models and our client portfolios are concerned is what we think is an achievable yield relative to the risk that we are taking. And in a balanced model, a balanced portfolio, we look back and we can see over the last 10 years of a portfolio that has been 60% equity, defined by a broad global stock index, and 40% fixed income defined by a Canadian bond index. We look at how that weighted return of a 60% equity and 40% fixed income portfolio has performed. And that's given us just a little under 6% over the last 10 years. So when we're talking about the relationship between stocks and bonds and mitigating risk, it comes to play in something we call the correlation between stocks and bonds. And Paul, I'll turn it over to you here a little bit, and you can talk about what you're seeing. But one of the things that we have been very focused on lately is that some of that historical correlation between stocks and bonds has been breaking down from time to time, not giving investors the same kind of protection that they might have had prior to the 2008 financial crisis.
Yeah, we can look at the U.S. correlation first. So this is the S&P 500 versus the U.S. 10-year Treasury, and as you can see, the bonds are in white and they are in yield or percentage terms, but in the bottom part of the chart, you'll notice a green shaded area. When that green shaded area is high on the chart, that provides the necessary benefit that we really want to capture. So that is when there's a risk off period or the risky assets in our portfolio might get hit or hurt or decline in value, the government bonds in the portfolio would go up in value due to a flight to safety or flight to quality switch trade, if you will, out of risky assets and into non-risky assets. Lately, over the past couple weeks, we've seen equities actually come off a little bit here, really over the past week, but bond yields are spiking higher, and that's going on around the globe as well, and we can see that in both the US and in Canada, and you can see how that green shaded area in Canada has really come off and in fact just gone slightly negative. And that's, to be honest, not really what we want to see from our government bond positions. We want to see them actually provide a hedging benefit.
Well, this is one of the reasons that we have been preaching having a more tactical approach to portfolio investing as opposed to just a buy and hold and wait situation, because these correlations are not necessarily always providing the same kind of support that they have historically. So we do look at things over a short-term perspective, but we also look at things over a very long-term perspective. Of course, our goals for all of our clients is to meet their goals, and their goals are always in terms of what their well forecasts are showing what they're trying to achieve. They show us, we build a portfolio for them with that in mind. And that's why we talk about these things and want to make sure that our clients understand the inner workings of some of the things that we do in order to provide them with the best risk-adjusted returns that we possibly can. So that's what we're going to talk. That's what we've talked about this week. We're really happy that you've joined us, and we want very much for you clients who are listening and other listeners, if you have any topics that you'd love us to cover, we'll try and cover those in ensuing videos. But thanks for tuning in to this one, and we look forward to having you back again next time.